Welcome back to Talk Tickers. This is the show where we ignore the press releases, we strip away all that corporate fluff, and we hunt for the real alpha buried deep in the earnings calls.
And we have a good one today.
Oh, we really do. Today, I was just glued to my screen this morning. We are talking Northpointe, ticker NPB. They just dropped their Q4 2025 results. And, I mean, if you looked at the price action, you'd think the sky was falling.
It was a pretty volatile open, to say the least. It's not every day you see a regional bank gapping down almost 3% at the bell.
Especially on what looked, I don't know, superficially like a decent quarter.
Right.
It was confusing. The stock opens at $17.59, down 2.6%. All the headlines are screaming, miss! They missed earnings per share by 8 cents.
There's a huge number in this market.
It's a death sentence. The algorithms trade those headlines in microseconds. But here's the thing that was driving me crazy. I'm looking at revenue, and it beat. I'm looking at book value, and it's skyrocketing. So we have to ask the question here. Is Northpointe actually stumbling? Is this a red flag? Or is this, a massive buying opportunity just disguised by some messy accounting?
That is the right question to be asking. Because if you treat Northpointe like, let's say, a traditional regional bank, the kind that takes in deposits and holds 30-year mortgages forever, you are going to completely misread this report.
Okay.
Northpointe isn't really a bank in that old sense anymore. It's becoming what I like to call a balance sheet factory.
A balance sheet factory. I love that. It implies velocity, right? Like they're manufacturing assets, not just hoarding them.
Exactly.
But before we get to the factory floor, we have to talk about the elephant in the room. The miss. Consensus was 60 cents for EPS. They posted 52 cents. That's what triggered the sell-off. Walk me through this.
Well, this is just a classic example of Wall Street shooting first and asking questions later. If you just scan the summary, you see 52 cents. But if you actually, open the filing, that miss was almost entirely manufactured by a single one-time strategic decision.
A strategic decision?
Yeah. They took a $3.2 million expense in the quarter that translates to about 9 cents per share.
Okay, 3.2 million. What was that? A bad loan? A lawsuit?
No, nothing like that. It was a capital restructure. They redeemed their Series A preferred stock. And to pay for that, they issued $70 million in subordinated notes.
Subordinated notes. Okay, pause there. We promised no jargon. Why does swapping preferred stock for subordinated notes cost them money? And why should we care?
Okay, think of it like refinancing your mortgage. Let's say you have a loan with a really high interest rate.
Sure.
You decide to refinance to get a lower rate, which saves you money every single month for years to come. But on the day you sign, you have to pay closing costs, right? Maybe a few $1,000.
Right. I'm out of pocket today to save way more later.
You nailed it. That $3.2 million charge is basically the closing costs on this deal. They're paying off expensive equity and replacing it with cheaper debt. The accounting rules just force them to recognize all those costs immediately.
So the algorithm sees a loss.
Right.
But a human analyst sees a smarter balance sheet.
Precisely. If you strip out that one-time charge, their adjusted EPS wasn't 52 cents, it was 61 cents.
Which would have been a beat.
It would have been a 1 cent beat against the 60-cent consensus. So the whole miss narrative is an optical illusion.
Wow.
And while everyone was freaking out about that, they missed the real number. Tangible book value per share is up 13.9% year over year.
Almost 14%. In this environment, that is huge. That tells me the factory is just printing equity. So let's go to the engine room. You called it a balance sheet factory. The core of that machine is the mortgage purchase program, the MPP. What's going on there?
This is where Northpointe really separates itself from, your grandfather's bank. The MPP is basically a mortgage warehouse for other lenders.
A warehouse.
They provide the funding so that mortgage bankers all over the country can close their loans before they go sell them to Fannie or Freddie. It's a volume game. And right now, that volume is just exploding. MPP balances are up over $1.7 billion year over year.
$1.7 billion. That's incredible scale. But I have to play devil's advocate. If they're holding all these mortgages, aren't they terrified of rates rising? I mean, we saw banks collapse over that exact thing in 2023.
That's the fear, yes. But that's where the factory model is so different from a storage model. Northpointe isn't trying to hold these loans for 30 years. They're moving them. They're aggressively participating out these loans.
Participating out. Break that down. That sounds like lawyer speak.
It's essentially wholesaling. So imagine Northpointe originates this huge batch of loans. Instead of keeping them all and bloating their own balance sheet, they just slice off a piece of the portfolio and sell the rights to other banks. In Q4 alone, they participated out $457 million.
So they're just acting as a conduit.
Exactly. They are the pipe, not the reservoir. By doing that, they get to keep the customer relationship, they keep the fee income, but they move the heavy asset off their books.
Which keeps their capital clean, so they can just rinse and repeat.
It turns the bank into a high-velocity flow machine, and the yield on that segment, 7.2% for the quarter.
7.22 is a serious yield. So they originate, strip the fee, sell the risk, and do it all over again.
Yep.
That explains the revenue beat. But there's another piece here I think gets overlooked, the AIO product. It grew 20% year over year.
Free all-in-one loan, yes. This is one of my favorite products because it creates incredibly sticky customers.
I saw the stats. Up 121 million in balances.
Yeah.
What is it, just a AULOC?
It's a first lien, AGOC, but it's structured as a sweep account. So it basically replaces your checking account. You deposit your paycheck directly into your mortgage.
Wait, what?
Every dollar you deposit instantly pays down your principal, lowering your interest for that day. Then when you need money, you just swipe your card or pay a bill and it comes back out.
So my mortgage is my checking account.
Correct. And think about the psychology of that. Once a customer sets that up, moves their direct deposit, links all their bills, they're never leaving.
It's the ultimate golden handcuff. You're not just the lender. You're the operating system for their entire financial life.
It's brilliant, and they're dominating that niche.
Speaking of borrowers, 2025 was a weird year for housing. Rates were up, then down, then all over the place.
Yeah.
Northpointe closed $2.5 billion in mortgage year, up 20%? That seems counterintuitive.
It does, but there was a really specific signal in Q4 that I think the market missed. Late in the quarter, interest rates dipped just a little bit.
I remember that.
And immediately, Northpointe's consumer direct channel volume just spiked. They netted $18.3 million in gain on sale for the quarter.
So the consumers just coiled like a spring, watching rates like a hawk.
Exactly. The second rates ticked down, the refi applications flooded in. This validates their whole thesis. They built this massive platform, and the moment the Fed actually cuts, they are positioned to capture a huge wave of volume.
Okay, so the factory is ready. But a factory needs fuel, and for a bank, that's deposits. This is where I start to get a little skeptical. They've got $4.87 billion in deposits, which is great.
Right.
But I saw a line item about a digital deposit relationship that brought in $234 million in Q4.
The funding puzzle. You spotted it.
That sounds like hot money to me. This isn't grandma's savings account she's had since 1980. This is rate-chasing cash, isn't it?
You're absolutely right to be skeptical. It is hot money. And it's expensive. Their wholesale funding ratio is almost 65%.
That is high.
It is very high. A traditional community bank might be at, 15%? Northpointe is paying a premium for this liquidity.
So they're renting a Ferrari, but they have to use premium gas.
That's a great analogy. It compresses their margins. But here's the counter argument. You can't grow assets by $1.7 billion without aggressive funding. They've made a calculated trade-off.
Lower margins on deposits for massive volume on assets.
It's a volume play, pure and simple.
But that leads to costs. Expenses are up. They're forecasting $138 to $142 million in non-interest expense for 2026. That's a big jump.
It is, but it doesn't really look like bloat.
Yeah.
I dug into the headcount. They hired 34 new mortgage pros in 2025.
Okay, so they're stocking the sales floor.
Right. And the other big chunk is FDIC insurance assessments. That's a regulatory cost because of that high wholesale funding we just talked about. The government charges you more insurance when you rely on hot money.
So it's good expense growth, if that's a thing.
It's directly tied to revenue-generating activities, yeah.
Okay, before we look ahead, I have to check the brakes on this Ferrari. Fast growth can mean bad loans. How's the credit quality?
I look for cracks in the armor, but honestly, it's pristine. Net charge-offs were $1.2 million. That's 8 basis points, 0.08%.
That's basically nothing.
It's so low. And here's the stat that blew my mind. The average FICO score in their portfolio is 747.
747. Wait, seriously, that's not a normal borrower. That's the credit score of a saint.
It really is. Usually, a bank growing this fast is dipping into the 640s to chase yield, but Northpointe is at 747 with an average loan to value of 71%.
So huge equity cushions. They're doing prime volume at speed.
Exactly.
Okay, credit is clean, volume is high, the miss was a fake out. What about 2026? Management is guiding for a net interest margin of 245 to 255. That feels tight.
It is tight, but remember they are baking in 2 Fed rate cuts, and they explicitly said that recent rate drops haven't hurt them, but if rates stay lower, they have upside.
And they're still targeting massive volume, 4.1 to 4.3 billion in MPP balances.
They are not slowing down, they're doubling down, and I think that's why KBW, the big analyst firm, came out today and actually raised their price target to $22.
Despite the miss.
Yep, rated it outperform. That's the smart money looking through the noise. They see a bank successfully pivoting to a specialized mortgage platform.
And the volatility this morning is just the price of admission for that transformation story.
That's the way I see it.
It really feels like the market has misunderstood this one. You've got a company growing book value at 14%, but it trades like a distressed regional.
And that disconnect is where the opportunity lies.
Which brings us to my favorite part of the show. We've done the homework, crunched the numbers. Now let's get a little reckless. It is time for our This Is Not Financial Advice segment.
And the big disclaimer, we are just two people talking into microphones. We are not your financial advisors. Do your own diligence. This is for entertainment purposes only.
Absolutely. Do not trade based on what we say.
Right.
But if you were a hedge fund manager pitching a wild idea right now, what's the trade?
Okay, I call this one the warehouse whipsaw, and it's a pair trade.
Ooh, a pair trade? Sophisticated. Walk us through it.
So the thesis is that the banking sector as a whole is in trouble. As rates come down, traditional banks suffer. Their loan yields drop faster than their deposit rates. Margins get crushed.
Okay. Traditional banks equals bad.
Generally, yeah. But Northpointe acts like a hedge against that. Because they're a factory, lower rates mean more volume. So here's the trade. You go long MPB. You buy the stock.
To capture that book value growth and the potential refi explosion.
Right. But you don't just hold it naked. You hedge it. You short KRE. That's the regional banking ETF.
Long the outlier, short the index.
Exactly. You're trying to cancel out the weather. If a massive storm hits the banking sector, new regulations, a commercial real estate crash, the ETF will tank. Your short position makes money, which should offset losses on Northpointe. You've neutralized the systemic banking risk.
So you've stripped away the noise and are left with a pure bet on the Northpointe factory.
Right. If rates stay flat, Northpointe wins on book value growth while the rest of the sector just treads water. You win.
And if rates drop?
That's the jackpot. If rates drop, the KRE ETF gets hammered because of margin compression. But Northpointe's origination machine goes parabolic from the refi wave. You make money on the long as NPV earnings explode, and you make money on the short as the sector struggles. It's a liquidity arbitrage play.
I love that. Using the sector's weakness as the catalyst for the specific stock's strength. The warehouse whipsaw.
It's high risk, high reward. But looking at these numbers, that divergence is just staring us right in the face.
Well, there you have it. We started the morning with a scary headline and a stock gapping down.
And we ended up finding a misunderstood balance sheet factory that's getting stronger.
A 747 average FICO score, 20% growth in those sticky all-in-one accounts, and a management team that is just aggressively buying market share.
The market punished the optics today, but that 2026 guidance suggests the engine is just getting warmed up.
That's all we have for today's deep dive. Remember, the headlines are just the wrapper. The alpha is inside the box. Do your homework, ignore the noise, and keep tracking those tickers. We'll catch you on the next one.
Thanks for listening.